Yo, what's going on? It's Lewis here, and in today's video, I'm going to be talking about 3 major market principles that you could use to help determine if it's a good time to get into a trade. And this is really cool because it doesn't really require any technical analysis at all, except for just a very, very small amount, and they're really good. So let's get to it. These things that I'm about to talk about will help you determine whether or not it's a good time to buy into a coin, and it'll also help you determine how long you want to stay in the trade without even using pretty much any technical indicators like Fibonacci or, moving averages or anything like that. So the first thing to take note of is the big even prices and how big even prices usually affect the market. For Bitcoin, these big even prices have been 1,000, 2,000, 3,000, 5,000, 7,500, 10,000, 20,000, etc., etc. This isn't always the case, but there is a lot of human psychology that is at play when it comes to cryptocurrencies, and humans really like large round numbers. So a lot of times there are major sell-offs and hard resistance levels at these numbers. Now, I don't like to just use these big round numbers as the only thing that I'm going to use. Obviously, I use a lot of other, real technical indicators when timing out my position and my trade, but I do like to keep these in mind just so that I have the psychological component in play when making my trades, because I like to see if there was, a big support or a big resistance at one of these large round numbers in the past, because that just gives me a little bit more, reassurance or confidence that the support or the resistance is going to hit at that level again. So I guess I'll show you what I'm talking about here. If you look on this chart, this is Bitcoin, and you could see these are the levels that I'm talking about, those big round numbers. This right here was around 3,000, and you could see it hit 3,000, and then it sort of tried to come back up, didn't quite get there, and it just stayed below it for a while, and then it hit it again. And then, you know what? It tried to hit it again, but it couldn't really break past it. Finally, it broke past the 3,000 mark, and it really went on a nice run. And yeah, it went on a run up to, 4,000, 4,200, but it continued that run basically up until 5,000, and that's when it had the major sell-off. And you know what happened? The major sell-off from 5,000 went all the way back and bounced off of the previous resistance, which was at 3,000. And so this is a really big round number. 5,000 is a really big round number. Bounced off of that, bounced back off of 3,000, came back up. When it surpassed 5,000, guess what it did? It went up to around 6,000, bounced back down, back up to 6,000, bounced back down. It didn't hit all the way back down at 5,000, but it had a hard time breaking through 6. And you know what? Once it broke through 6, it actually surged through 7, but it went and it stopped and got resisted at 7,500. Another pretty big round number, came back down. And if you were to say, okay, I'm going to use the last resistance, which was around 6,000, that's where it bounced off of as the support. And then it came back up, broke through the 7,500 level. And, there's like a little bit of back and forth around the 8,200, 8,100. So, it's not always 100% exactly 7,500 or exactly 6,000. But they do tend to have a lot of sell-offs and a lot of resistances around these numbers. And you could see this was the 10,000 mark. There wasn't really anything going on all the way from 8,000 to 9,000 to 10,000. But then finally when it hit the 10,000 mark, there was a little resistance that happened. And then it broke through 10K and just totally surged up all the way. If you, count this 1, 2, 3, it went all the way up to 20K, right? And even if you do count this was at 17,000, just around 17K. But ideally, you could see right here, it went all the way up to 20K, like 20,000. That's a really significant, psychologically significant number. Came back down, came back up, and it hit 17K again. And then it came back down, and then it settled and had the resistance around the 11,500 mark. And then it came back down, and guess what happened? 7,500, that last resistance level that it used to be at over here, Now it's over here, it's 7,500. It did actually dip below, but if you look at some of the other indicators, you'll see that when it hit this point, it was drastically oversold, and this would have been the best time to buy down here. But then it went back up, and look where it had the resistance again, 11, right around the 11,500 mark, 11,500. It's not like 11,300 or 11,239, it's 11,500. So, like I said, this doesn't always count, like it's not always legit, and you have to obviously use other technical indicators and other things going on, but it's something to keep in mind. So if you're pretty confident that there's going to be a sell-off around one of these large numbers, big round numbers, it's probably going to be a good idea to get out a little bit beforehand. Don't get greedy. If it looks like there's going to be some resistance at the 11,500 mark, then, get out at 11,250 or 11,400. That way, you'll be more likely to lock in your profits. And remember, realized gains are always better than potential gains. And if it happened to just, break through, then you could just always buy back in and run up the next rally. Or alternatively, you could watch the charts like a hawk as it starts making its way up. And then let's say right when it passes the 11,000 mark, you could start just watching it very, very closely. And you could set a stop limit order at that position. That way, if it keeps on going up, you'll have all of your original position in case it happens to bust through the resistance. And because you'll have a stop limit order in place, you'll also be protected in case it comes back down. The second thing to look at is the previous price levels. So most of the times, like I mentioned before, the previous resistance tends to become the new support. Here is a great example of that right here around that 3,000 level, where it just had a really tough time breaking through. And then finally, once it does break through, it comes back down, but then it bounces off. And now what used to be a resistance right here is now a support right here. And you could see that again right here where this was the resistance. And then it went up and it came back down and it bounced off of the old resistance, which is now the new support. So it's always possible that the old resistance will become the new support when the coin corrects itself, and there is always a correction. And yeah, sometimes it doesn't dip as low as you thought it was going to, say right here, it didn't dip all the way back to the 5,000 level, as you could see, after it bounced off of this resistance. So you might want to have it set, your buy orders a little bit above the old resistance levels, or AKA the new support. And that way you'll get in if it comes back down, but not all the way down. Other times though, it'll correct way more than you thought it would. And that's also why having a stop limit order is a good place, so that you could quickly get out of the trade if you buy in and it keeps on dipping, and then you could buy back in. And here's an example of that. Like, would you really have thought that Bitcoin would go all the way down from 20,000 down to 6,500, like under 7,000? Would you really have thought that? I mean, I would have thought that this right here, the 10,000 mark, would have been the lowest it would have went. So, I put my buy-in orders over here, but then, it kept on falling, and I was like, oh my God. So, a smart decision would have been to set a stop limit order right around here, a little bit below the 10,000 mark. I didn't do that. So once it got down here to the 7,500 mark, that's where I really went heavy in my buys. But yeah, it's always a good idea to check back to the previous numbers. And especially if they're a big round number, like 10,000, that's probably going to be a good place to set the new buy orders, because it's probably going to go down here and then shoot back up. And then the third thing that I want to talk about is having social awareness, and just having an awareness of the sentiment that is around crypto. Is everyone praising it and saying how it's the best thing in the world? And when I say everyone, I mean like people who aren't really into crypto. Is it all over the news? Like, is the news just parading it around, telling people how to buy it up? And I mean, is it the talk of the water cooler? If it's all of these things, then you actually might want to consider selling it, because it's probably going to be on a big rally, a big parabolic run. And what you want to do is you want to sell, a little along the way and try to catch the top, but you never will actually catch the top. And that's a lot of times where big round numbers might come into play, because you have that psychological factor. So you might want to sell it a little bit below the top. Or you could just simply set your stop limit orders, continually trailing the price as it continues to go up. And that way you would have sold it, right here, because you would have had your stop limit orders up, 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 up. And then it would have fallen down and you would have sold it. And so you would have sold it here, at like 16,000, 17,000, and you might not have gotten all the way up to 20, but it still would have been a really nice run if you would have bought it down, right here after the breakout at, 8,100 or 8,200. And you know what? The opposite is also true when it comes to this psychological factor. I mean, when things are down 60, 70, 80% maybe, and everyone is really hating on crypto and everyone's just really angry and mad about it, and there's blood on the streets, as Baron Rothschild likes to say, that is actually when smart money comes in and buys it up. And that's when, you might want to come and buy it up too. Obviously, I'm not a financial advisor, but that is pretty good advice, especially for investing. And I pulled up this graph, the psychology of market cycle graph, because it's something that I am really trying to just nail down because it's so fundamental. Every cycle, every market goes through this cycle. So, this is what I just talked about. This is when your, technically challenged mom is talking about buying Bitcoin and asking you, how do I get in on this? That's when this is happening. And, that's when you probably want to get out. And then, it goes down. And then finally, down here, everyone starts panicking and selling off a lot of their coins. And then this is where you want to buy. It's where you want to start accumulating your coins so that when it starts coming back up again, this is when you want to have the most of your trades, because you're going to be winning a lot in this. And you could always, say if you mess up on a trade in this really long bull run, then you might be able to, wait a little while, just a very short amount of time, and it'll come back up again. However, if you mess up during the bear market or the downtrend, then you're going to be in a lot of trouble. And this is where stop losses really come in handy down here, because if you mess up, it could just keep on going down. And like I said before, this is really good. This is really, really good for investments and long-term trades. And you got to remember, this is crypto. Crypto is new. A lot of new people who have never traded before are coming in here, and they are very emotional in their trades. So if you could take the emotion out and you could use logic with your trading decisions, then you will just crush it. I pulled up just one chart which sort of looks like a good idea, because you could see right here, this is really, really low, and it's basically at one of the lowest points that it's ever been at. And this is for one particular cryptocurrency. It's called SALT. And basically, this might be a good buying opportunity, because if you look at the chart, what does it look like? I mean, look at this. It went up, and then there's a double head, and then it came down, and then there was a little false breakout right here, and then it went down, and now it's over here. And if you look at this, it went up, and there was a double top, and then it went down, and there was a little false breakout, and then it went down, and now it's over here. So this might be something that I would look into for a really long-term trade. And that's pretty much it. Those were the 3 different techniques, or I guess you could say basic market principles that you could use that will help you to determine, whether it's a good time to get into a trade or not. And they really doesn't require that much thought. It doesn't I didn't use, Fibonacci or, moving averages or MACD or anything like that. Although I do obviously would use those things, but these are just bigger picture concepts to think about when buying and trading cryptocurrencies. That was it. Thanks for watching. If you liked it, be sure to give it a thumbs up and subscribe. I got a lot more videos like this coming out. And if you're new to cryptocurrency, I do have a free course for you in the description. It tells you what Bitcoin is, Ethereum is, the blockchain technology. It tells you everything you need to know to get started with cryptocurrencies. So that's totally free. It's in the description if you want to check that out. Otherwise, let's get to the moon together. I'll see you in the next video. Peace out. Bye.